All right, well, I think that we can get started. We're at 3 minutes after the hour. Welcome everyone to this year's State of the Sector webinar. This is a webinar that we host every year alongside the publication of our annual report. And we're very excited to host the conversation that goes with the report around what are the key challenges in this sector and how we can tackle them as lenders and support agriculture SMEs as well. So I will start by introducing myself. My name is Andrea Zinn. I am the director of CSAF. And if you're just joining, I'll invite you again to have the guests introduce themselves in the chat. Feel free to ask questions throughout the webinar. We have a big agenda today. I'll give a brief overview of CSAF for those who might not be familiar with our work. And then I will invite Ada Dokle, our data and learning manager, to go into the details of the data and dig in around some of this year's trends. And then we'll have a really engaging panel with Paul Sadlich from Shared Interest and Maria Rural Carula from MCE Social Capital. We're trying to give a pretty healthy time slot for the Q&A, so we extended the webinar to 75 minutes to make sure that your questions are answered throughout the webinar. Please keep your questions flowing. We'll take some live questions as well, and we'll try to answer as many as we can throughout today's session. So to get us started, I will give an overview of CSAF, the Council on Smallholder Agriculture Finance. We are an alliance of lending institutions and field-building partners with a shared commitment to build an inclusive and sustainable financial market for agriculture SMEs. And CSAF members convene to share learning, develop industry standards, and engage other stakeholders. And we really convene around three main objectives. First and foremost, market growth. So facilitating market growth to meet a greater share of the financing needs from agriculture SMEs around the world. Second is responsible lending practices. So how do we promote those responsible lending practices, do that lending in a way that also ensures social and environmental standards and supports that the market growth for agriculture SME finance contributes positively to the impact on smallholder farmers, on workers, on their rural communities, and of course on the natural environment as well. And then thirdly, we are building a stronger ecosystem. So here we're focusing on how that ecosystem for inclusive and sustainable financial markets and agriculture value chains can become stronger and support the growth of SMEs and the financing that is provided to them. So I will also take a step back and make sure we're all on the same page about why we're focused on agriculture SMEs. CSAF specifically gathers around agriculture SME finance, so that financing at the business level to producer organizations, to cooperatives, to private enterprises that are sourcing from smallholder farmers. And the reason we're focusing on these organizations in particular, in the way that we convene and the conversations we have and the data we collect, is because these organizations are more costly to serve. They tend to be more risky and less profitable than other sectors. But we also recognize that they have a really incredible potential for impact. And that's why each of the CSAF lenders that are involved with CSAF and are working in this sector are here. We're here because of the impact that these SMEs are generating in their community. They are high cost and they're high risk, but they're also high impact. And the origins of CSAF were really because many of the CSAF lenders who were serving these SMEs were facing these challenges of costs and risks independently. And at the time, the sector lacked the resources and the tools to evaluate and serve SMEs. So it was an opportunity for CSAF members to come together and provide that infrastructure and provide data to the agriculture SME finance sector, and an opportunity to foster that collaboration and avoid making the same mistakes. So today we are counting 18 members, and we've had a really active year. In addition to collaborating at the regional and global levels and producing the annual data analysis, we also expanded our data collection to collect more information on technical assistance and institutional costs. We're renovating our joint monitoring tool to support cooperatives and SMEs to manage their price volatility risk. And that's thanks in funding to Coffee Circle. And we continue to host the Agriculture SME Learning Collective, which has delivered guidance on our segmentation approach for delivering BDS and TA services. And we're continuing to work on a catalytic capital framework to assess additionality of concessional capital that targets SMEs. So it's been a busy year. Every year is busy for us, and we're just keeping consistent to move the needle on agriculture SME finance. And we do that also in thanks to the support of our field building partners who make a financial contribution alongside the data and financial contributions that come from our members. And field building partners are really a set of stakeholders that are aligned with our goals of promoting more inclusive and sustainable agriculture SME finance sector. And in addition to being learning partners, their support ensures that the data and the insights that Ada will soon be presenting, as well as the annual report and our open data portal, remain publicly available and continue to be a resource for the sector. So with that, I will jump into some of the numbers. Ada will be going more deeply, but the headlines this year are that CSAF members collectively dispersed nearly $800 million, and we now have a dozen years of data. That's nearly 17,000 loans dispersed. This 800 million is an all-time high since we've been collecting data. And I do think it's important to pause here and recognize the vastness of this number, because over 12 years, $7.7 billion comes with a lot of hard work in the region. And at the strategic level, there's investments officers who are working passionately because they believe in the impact generation. They're traveling long hours to farms and remote businesses. And that comes with a lot of lessons learned and a lot of impact earned along the way. So 4 of the top trends from the data and from the conversations that we've been having with lenders this year is, firstly, our lending volume increased by 100 million. So it more than made up for the decline in 2023, and it marks the highest annual lending volume to date. The number of borrowers remained about the same, and this growth was primarily driven by increased demand for financing that was tied to higher global prices for coffee and cocoa. So while that lending volume increased, a really interesting trend is also that the lenders supported new borrowers at smaller ticket size. So the median loan size to new borrowers dropped down to 250K. And I think that's really a symbol about how lenders are working to reach businesses with smaller capital needs that really have a lot of potential to grow for impact. And eventually they can scale their impact and the farmers that they're reaching. We did see risk increase in 2023 while different SMEs were managing overlapping crises. And we saw the result of that in write-offs in 2024. So write-offs nearly doubled. These risks include price volatility, climate shocks, management challenges among SME management teams. And while write-offs did increase sharply as a result of last year's risks, it is important to note that they're still down from peak volumes in 2020 and 2021, which were more aligned with the COVID pandemic. And overall, PAR 90 at the end of 2024 dropped down to a more historical norm. And then lastly, what can't be ignored is that the shifting foreign aid policy, shifting macroeconomic conditions, ongoing wars, all of this context that we're working in now really leads to increased uncertainty. It's still hard to assess the full effects of inflation, of decreased foreign aid flows, of tariffs, and other large-scale economic factors that have really changed the context in 2025. So although we're reviewing 2024 data, we are living in the 2025 context. So we're also going to talk today in the discussion about what we're expecting moving forward. And we hope to also highlight how the agriculture SMEs and lenders are really acting to build resilience for what lies ahead. So with that, I will gladly hand over the microphone to Ada Dokle, who can get into a lot of these details. And again, while Ada's presenting and while we get the panel started, I invite everyone to share questions in the chat, and we'll try to answer as many as we can today.
Thanks, Andrea. Hi, everyone. Welcome to this data journey. We'll take a few minutes to unpack the data from 2024 from the CSAF lenders, and we'll start from the top. I know that Andrea already mentioned some of these numbers, but it's helpful to start from the top. So in 2024, the CSAF member lending reached close to $800 million annually, and this went to reach over 600 borrowers, which are both private companies and cooperatives, and they are spread across over 50 countries, with a goal of reaching roughly 2.8 million smallholder farmers. These are the big numbers, but we have a few more slides that look into three main pieces of analysis that are the disbursements, the borrowers, and risk. We'll start with disbursements, and the slides should start with this chart on the left that shows the trends in disbursements. So you see that there is a growth in disbursements in 2024, and this growth in lending practically accounts for 40% to the prior year. You'll hear me talk about growth in this presentation, especially in the disbursements part, but I think that the variations in the types of growth are what makes the story interesting. So let me go back to this slide on the left and look at the trend. So we have a bit of a decline in 2020 COVID period. Then we had 2 years after the 2021 of increase, then a bit of a flat disbursements decline in 2023, and now we are at peak levels in 2024. As I mentioned, the variations are interesting, and we'll start by exploring them initially by region, which is what the chart on the right-hand side does. So I will start with Sub-Saharan Africa, but let me say upfront that the three main regions, which are Sub-Saharan Africa, South America, and Central America, they experience growth, but there are differences in this growth. Sub-Saharan Africa, which is that darkish bluish part on the chart, accounts for over a third of global disbursements in 2024, and it's the largest share a region has in that year. The disbursements grew in Africa, but the growth is within single digits. And if we zoom in and look by country, the story is unpacks different trends. So let's start by looking at Cote d'Ivoire and Uganda. These are two countries that account for close to half of the regional disbursements. In Cote d'Ivoire, we noticed increase in disbursements in 2024. Meanwhile, in Uganda, the disbursements were practically flat in 2024. There are other trends within the region. We see increase in coffee DRC. We see increase in commodities other than coffee and cocoa in Ethiopia, and then decline in countries like Mozambique, Burkina Faso, and Tanzania. The second region is South America, which is the one with a lighter blue, and it's the region which experienced the largest growth practically last year. And this largest growth follows the steepest decline in 2023. If we look at what is contributing to this growth, we think first of Peru, which is the country that takes up 62% of the regional lending activity. However, the growth in Peru accounts for only like 6 million, and it does not account for the majority of increase in the region. So the increase in disbursements to South America comes from other countries like Ecuador and cocoa, Colombia and coffee, and then Peru and Argentina. Central America is the other one of the top three regions, and disbursements to Central America grew to peak level in 2024 after a few years of like following a fluctuation trend. Even here, if we look at disbursements by country, Nicaragua continues to be the country that receives the largest share of disbursement. And the disbursements in Nicaragua increased, but they were coming from increasing disbursements in coffee. Mexico and Guatemala are the other two countries that have largest disbursements in the region, but disbursements in 2024 in both countries remained almost flat. The other region is South and Southeast Asia. It accounts for like a small share of overall disbursements. And Philippines and Indonesia are two main countries, especially for the accounting for most of the disbursements in 2024. In terms of value chains, we're looking at coffee and cocoa for half of the disbursements, and the rest is going to coconut, maize, fish, and others. So this increase in disbursements is largely a response to the financing needs that borrowers had that were related to increases in coffee prices and cocoa prices last year. I want to say that I'm providing a lot of percentages that are not in the charts right now, but don't worry, at the end of the presentation, I'll show you where you can do your own analysis by yourself. Andrea, I realize that the slides are not as we were hoping to be, but this is good. So moving on to the analysis by value chains, there is strong growth in top two value chains. Coffee is the top main value chain, and this has been the headline for a few years now. But if we look at coffee disbursements for 2024, there is an increase by 20%, following a similar decline in terms of percentage in the prior year. So you'll see a steep decline and then an increase. Yet we're not at the peak levels of 2022, if you can look at the chart. If we look at coffee disbursements as a share of overall disbursements, that share has changed. In 2026, there was a coffee disbursement share less than 40% of total disbursements. But since 2016, the share of disbursements to coffee has increased, and now we are at a share of over 50% of overall disbursements to coffee. Most of the countries, in terms of coffee disbursements, have rebounded in 2024 because they experienced a decline in the prior year. But the increase specifically in Peru does not match the decline in the prior year. So if we're talking about Peru, the increase in coffee disbursements was approximately 14 million, compared to the drop of approximately 44 million in the prior year. However, if we are talking about coffee, countries like Nicaragua, Colombia, and Honduras experienced and contributed to the increase in coffee disbursements in 2024. Cocoa is the second most financed commodity, and it increased to peak levels after 2 years of decline. And it's the line in blue in the chart. Most of the disbursements come from disbursements to cocoa in Cote d'Ivoire, followed by Ecuador and Peru. And that's where we saw also an increase in disbursements. So in Ecuador and in the Philippines. The increase in disbursements, as I mentioned before, is highly related to and linked to the increase in cocoa prices. The third group of commodity is nuts. So in nuts, we see almost like a flat trend, and the countries that are contributing to it are Kenya and Nigeria. Primarily, we see macadamia nuts as a main representative of this group, but cashew nuts are also a good share of this commodity group and value chain. If we're looking at the next chart, it's coffee lending, value chain lending actually by region. So that's in terms of share. But before I move to the analysis by share, I want to say that coffee disbursements increased in the three main largest region, with the biggest increase in absolute values happening in South America. If you look at the share of value chains in this chart, you'll notice that it's Central America that has the region with most concentration in coffee, with over 80% of lending activity in the specific value chain. Again, in this chart, you'll see that we have other commodities, and in a global sense, so not broken down by region, the other commodities account for over 20% of the disbursements in 2024. And here, over the past 5 to 6 years, in this 20% of disbursement, there have been like over 100 types of commodities, ranging from cereals to fruits and vegetables, which are the main contributors to this 20% of disbursements in the other commodities. So this is by value chain, and this was disbursements by region and value chain. I think as a next step, we can drill down into borrowers, and we can start to look at what happened in terms of number of borrowers served in the past years, and then try to understand how these borrowers were financed. So after years of contraction from the peak that was reached in 2016, the number of borrowers in the past years have remained consistent. You'll see that from 2019, the number of borrowers has changed only by a bit. The concentration shows like the CSAF members being focused on serving the existing borrowers, but we see that year on year we have new borrowers. And for 2024, the number of new borrowers to the whole CSAF portfolio was 91. These clients are a combination of clients that are new to portfolio, but also clients that return to the portfolio. I want to highlight that the new borrowers, the number, given that the total number of borrowers has remained almost unchanged, the number of new borrowers is also like a reflection of the client attrition from the portfolio. If we look at the regional level, you'll see that Sub-Saharan Africa accounts for 45% of all borrowers and is followed by South America with over a third, and then Central America. Broken by new borrowers served, 40% of the new borrowers comes from Africa, followed by similar share of 40% coming from South America. So this was borrowers in terms of trend and distribution by region. Next, let's see how they're being served. And in terms of borrowers financed by a single CSAF lenders, we have 470 borrowers that were financed by a single lender in the recent year. And this continues to account for the largest segment in the CSAF portfolio. So you'll see this 77% of the total borrowers, they are served by one CSAF member. There is a bit of an increase from the prior year, but that is accompanied by a decline in disbursements, which you can look at the chart on your right. If you look at the top part of the chart, you'll see the share of borrowers that are served by multiple members. So 23% of borrowers are served by multiple members account for over half of the disbursements. And this has been the case for a few years now, but you should keep in mind that these are usually borrowers that have a longer term relationship with CSAF members and receive multiple financing from different lenders, contributing to the large share of disbursement. Going back to the borrowers that are served by one CSAF member, I want to highlight that a good share of these loans, over 40%, are through loans that are smaller loans, less than 500K. And if you look at this share, this is definitely smaller for borrowers that are served by multiple CSAF members. So we started to look at loan size to borrowers and number of members serving different borrowers. So it's helpful to look at the loan size. Andrea started to talk about this, and we usually talk about average loan size, but we wanted to look at the median loan size and look at the trends, how it has changed since 2015. So if you look at the chart on your left, the median loan size has experienced a gradual increase over the years, but in the past year, it declined for total borrowers. So the dotted line reflects the all borrowers. However, if you look at the split between new and existing borrowers, you'll see that the median loan size to new borrowers has declined and dropped to 250K, which shows that the members are providing financing to businesses with smaller capital needs. This is consistent with the trend from 2015 to 2024 that you look at the left-hand side is consistent with a decrease in share of loans less than 500K that you see in the chart on the right. But if we zoom in the past 2 years, the share of the loans that are less than 500K has increased from 35 to 38%. And this is coming primarily through new clients. Last but not least, we talk on the next slide about risk. So we have seen an increase in portfolio at risk greater than 90 days to 8% in 2023, which dropped to 5.1 in 2024. And we can see that in the next slide. Yes. This decline in PAR, so improvement in portfolio quality, is definitely balanced by the write-off trends. But before I move to the write-offs, let's look at the trends in PAR 90 by loan size. PAR 90 has decreased for all loan bands, and as you see from the chart, but it has not decreased for the buckets it is between 250 and 500K. Smaller loans definitely continue to present more repayment risk than the larger loans. And if you look at only the larger loans, more specifically, the ones that are over 1 million, you'll see that the one within the bucket of 1 million to 2 million remain the riskier one. So we said that PAR has declined, but at the same time, we noticed that the write-offs have doubled. So the increase in write-offs is definitely a reflection of all the challenges that the sector has faced related to price volatility, climate shock, and management challenges. Despite the increase, we're not at yet peak levels that we observed during after the COVID pandemic. I wanted also to highlight before I end the session that also the restructured loans had increased in the past 2 years, which is confirming a way that the lenders are trying to find ways to support the clients, especially when facing different types of risk. This is it in terms of data, but I want to highlight that this has just scratched the surface, and there is more to be done with the CSAF data. We have built a data portal that we have shared with everyone, and I think this has existed for a few years now, but if you have not seen it before, I would like to share it with you so that I can show a bit of a structure. Bear with me, I think this is interesting. So the link is very simple. You can find it in the report or in the CSAF page. You'll see that there are analyses grouped by topics, and the main topics are like disbursements, clients, loan sizes, and the groups that we try to highlight today in the data presentation. But this allows you to look at all these percentages that I mentioned in the presentation without having to note it down or remember, and do your own analysis. So you have the topics here at the top, but also you have these tabs that allow you to explore more of the narrative under each one of the topics. You can use the filters here to get more details on the data. And yes, feel free to navigate it. If you have any questions or recommendations, do share that with us. Thank you, and back to Andrea.
Thanks so much, Ada. As Ada mentioned, there's just so much data that we can look at and so many ways that we can slice it and dice it. And it's really a challenge each year to decide like what can go into the annual report. Like we try to keep the report concise. So the data portal is just a great tool for people to go in individually and explore the data in a way that's relevant to your organization and your mandates for your work. So Ada does a great job of putting all of this together each year. We're very grateful to have her on the team. And I will add that this data is only as good as the context that it's given by our lenders. We're always going back to lenders and asking about the data trends and trying to explain them. And that's why I think having the practitioner perspectives is so important. And I'm very excited to transition into the panel for today's session, where we'll be hearing from Paul from Shared Interest and Maria from MCE Social Capital. So I'll ask Maria and Paul to turn on your cameras and join us for the session. And I will remind everyone that if you can share any questions you might have in the chat, we'll try to answer as many as we can throughout the webinar today. And with that, we can get started. Paul and Maria, we can start with some of just the headline numbers. I mean, lending increased to 800 million this year in 2024. And a lot of that we tied to the increase in demand for financing as a result of the record high global prices for coffee and cocoa. This is a trend that we see year over year, like the disbursements following some of the commodity price trends. So we can start with Paul. I would love to hear about how the commodity price might have influenced your portfolio and how you as a lender and you see your SMEs are navigating the current price environment as those prices still remain high and volatile.
Thank you, Andrea. I think it's important to start with a brief history recap on prices to understand where we are at now. So average coffee prices, let's say Arabica coffee, in 2023 were no more than $2 per pound, while in 2024, it increased to 2.6 on average. This is nearly 30% more in 1 year. So towards the year end, we had already surpassed the $3 barrier per pound. And just after 2 months into 2025, we reached a 50-year historic peak of $4.4 per pound. So in cocoa, we saw a similar trend. Prices in 2023 ranged between $2,500 to $3,000 per metric ton on average. And by the end of that year, we had surpassed the $4,000 barrier. And who could have foreseen that cocoa prices would have reached up to $12,000 per metric ton by April 2024, never seen before in the market. So, and you can ask, what do these gigantic price increases mean for cooperatives and agri-SMEs? It's a colossal pressure on cash liquidity to collect the produce with even more aggressive competition from coyotes and intermediaries, most likely. It's certainly beneficial for the individual farmers, I would say. They can see their family income boosted. However, at the same time, it requires having the capacity to source not only sufficient working capital and pre-finance, but also having it at the right time. I always say that money that arrives late tends to be useless in these commodity markets. So, and therefore, we collectively as CSAF members have sought to cover those incremental financial needs to the best of our capacities, and we've seen in the statistics shared by Eda. And also, certainly, at least in Shared Interest, we have lent more to our existing portfolio of customers to help producer groups navigate this high price environment. For me, it means to be capable of acknowledging those needs and acting accordingly and fast. So we also see this as a matter of continuing building relationships with cooperatives, with agri-SMEs for their almost, I would say, unlimited need for growth. So let's not forget that facilitating trade, especially if it's fair trade, is one of the fundamental tools to alleviate poverty. Now, in this forever changing market, prices have recently started dropping. Now, so we're currently just below or around $3 per pound in coffee, while in cocoa is just above $8,000 per metric ton, but still higher than historic average prices. So this means that cooperatives still need access to sufficient liquidity, but further attention is to be given to price risk management. So as in the end, as one of the constants of the commodity markets, it's unpredictable volatility. We need to keep considering their risking factors and how we can support agri-SMEs to maneuver these challenges.
Yeah, absolutely. I mean, price risk is a consistent part of our conversation, but it is a consistent part of the conversation because it's a consistent risk that we're seeing every year. It's become one of the biggest threats to producer organizations. And I think it's really important to note that agriculture SMEs are connecting farmers to market, and they carry this burden of the price volatility. So I'll turn also over to Maria and ask, like, how have you seen SMEs navigate the risks that come in times of high prices? And are you seeing similar effects with the SMEs that you're working with?
Thank you, Andrea. So yes, I mean, I fully agree. SMEs carry that burden of the price volatility, and that is absolutely independent on pricing being high or low, right? It's the volatility that puts them at risk. And the critical pressure point here is always the liquidity. So I agree with Paul 100%. This business need enough cash on hand to pay farmers on time, and the on time is the key word here, especially when they're competing with other buyers in the region. And given that Paul has gone very much in detail of the sector-wise, let me give you a real example of one of our agri-SMEs. One of our coffee partners just a few months ago faced a liquidity crunch during peak season. Prices were high, it was coffee, so prices were sky high. And what made it worse is that suddenly a season that should be 2 to 3 harvests condensated, collapsed into 6 weeks. And that was because of La Nina and climate change. Farmers were ready to sell, and were ready to sell fast. But aggregators like our company and exporters like our company didn't have enough working capital. Many of them in the region shut their doors temporarily because they had to cool down the season because they couldn't pay farmers. So only our company stayed open and purchasing. And the question is, why and how they do that? Because of trust. First, what they did was they negotiated delayed payments to farmers. We don't like to see that. However, in this case, farmer agreed. Why? Because of the years of fair pricing, of the years of reliable payments, low or high in the terms of pricing, and the strong support they had received from that organization. By doing so, by them accepting to delay their own payments, they automatically freed up working capital for that company that otherwise it would have not been made available. In parallel, what happened? This company remains open. They are the only ones purchasing from farmers. So obviously all the farmers go to them. This company also had very solid commercial relationships, and were able to place additional volume of coffee into the international market because of that solid commercial relationship that they had with their own buyers. So overall, it's a great success story. This company now is being requested by all the farmers in the region to be part of, because they know they are the only one they can count on. So to me, what it tells me is that supporting agri-SMEs that prioritize at any point in time farmer livelihoods, it is critical, because it can quite literally save you the season, like in this case. I want to zoom out though, because despite there are companies like that, some reports tell us that most of the coffee farmers still live below poverty lines. And here I'm referring to the latest 60 decibels Coffee Farmer Thriving Index. It focuses in 2 countries, cooperatives in East Africa. But some of the estimates tell that between half of the coffee farmers up to potentially 80% of the coffee farmers live below poverty line. And they are increasingly exposed to price swings like the ones we see often without that financial cushion to fall back on. So some of the things that we've been hearing from other partners, this one comes from Colombia, I think that is an important thing to the next potential topics we'll be talking about is investing in farmer education. Not only the TA to the companies is good, but investing in farmer education that things like savings, smart reinvestment during high price seasons can make a real difference to manage that volatility, that price volatility that they are exposed to.
Yeah, absolutely. I mean, we see that the support services that the SMEs provide to farmers are just absolutely crucial. And then the other crucial component is that capacity building that's provided to the businesses themselves. And I think it's important to note that TA and capacity building are in consistent demand, and that capacity building requires funding. And we are seeing a shortage in funding right now as policies on global aid have shifted around the world. And I will share that CSAF is working on a price risk management project right now. We received funding from the Coffee Circle Foundation to renovate our monitoring tool that supports borrowers in coffee as well as cocoa and other crops to manage their price risk. And I think it's a really unique opportunity where a coffee buyer is contributing directly to the work to support agriculture SMEs, because at this business level, that risk is constant. And we're always talking about risk in these conversations. Many are inherent to the sector. Some are inevitable, like climate risk, and then others maybe are more manageable with the right types of training around governance and management teams. And one of the headlines from this year's report is that write-offs increased. And at CSAF, we standardize write-offs. So our methodology reports any loan that's defaulted for more than 365 days to be considered a write-off. So those numbers are not necessarily reflective of actual member behavior. Some members are willing to wait even longer to see if they can help recuperate the loan and the business. But it does mean that these write-offs are reflecting the challenges that came about in 2023. So I do think it's important to ask lenders, you know, how do these write-off numbers and these risk numbers, how do they influence the decisions that you make in the future? Are you like more willing to diversify your value chains? Is it better to stay safe in the crops in the countries that you know well? So how are you shifting your approach if you are shifting your approach? And I would love to have both of you answer this question. Maybe we can start with Paul and then go back to Maria again.
Thank you, Andrea. Yes, I think these are provocative questions. Now, CSAF members tend to be immersed in this dichotomy of impact versus risk. Now, and I would say that in the agricultural sector, especially with cooperatives and agri-SMEs, there is a thin red line between these two variables. But the ethos of a social lender encourages us to reach those ones that would rarely be attended by the traditional financial system. So in parallel, we also have a responsibility with our investors and donors, irrespective of the return, either social or economic, they are expecting. No? So with those considerations in mind, in shared interest, for instance, we have sought to reach the smallest producer group, sometimes with credit facilities of $100,000. So we know that a sustainable portfolio, we all know that it requires limits much higher than that to cover the management cost. So that level of funds is usually allocated to the riskiest and most likely less developed cooperatives. Now, certainly, no CSAF member will lend blindly just for impact purposes. Now, we carry out deep due diligence processes to try to mitigate risk. We accepted traditional supply chains such as coffee, cocoa, or nuts are either more regulated or the risks are well acknowledged, as we have been supporting them for decades. So personally, I believe in the importance of diversification, and although a slow process, by taking measured risk, we aim to support other crops where impact is high. And of course, impact can be measured in different ways, depending on the focus or interest of each lender. For instance, just as share an example, in early 2024, shared interest provided working capital to an agri-SME from Rwanda trading in horticulture, which gathers more than 1,600 farmers, of which around 80% are women. So yes, we CSAF members Do not fear risk. If you fear too much risk, my personal advice is change the sector urgently. No, but we try to take controlled steps to achieve our mission, certainly.
Thanks, Paul. That definitely resonates with me. Maria, is MCE thinking similarly? Do you have a similar approach?
Yes, we do, except for the 100,000 loans that we cannot do because of many other items that unfortunately we take in mind, like our fund sustainability. However, I want to share with the group my first reflection when I saw the level of write-offs. And for me, the first reflection was, how long have these lenders provided support to those companies before these companies fell into default, right? That's why, to me, the restructuring metric is the most relevant one here. Every lender here that is today participating or in the CSAF group has a potentially completely different risk appetite, but we know that we take more risk because of the impact case. So at MC, I believe that our impact contribution shows more than ever when the company struggles. And one thing we know for sure in agriculture is that the company will struggle, which is the no when, but it will. So in those moments, what we do is to elevate something we call internally impact preservation. We don't put a hard stop button when the company is in crisis, we engage. Because saving the company not only ensures we recover a loan, but it means protecting jobs, farmer livelihoods, household livelihoods, and whatever other impact that the company has generated throughout the years. To me, that's when the true colors of impact lenders show, right? But the aspect I always raise is that we're going to do that alone. It cannot be that the lenders are requested to basically turn organizations around because we're not the only stakeholder. So going back to the specific question, Andrea, you were asking, at MC level, are we changing lending strategy because of the write-offs? And the answer is not exactly. We are not pulling back, we are improving. What's changing is the quality of our due diligence and the way we structure our loans, shaped all this by the experiences we had these past years. So things that we're doing different. We take a deeper look at the way that our loans are structured vis-a-vis the business model of the organization. We look at governance structures, especially decision-making between board and management, much closer, because many of the challenges we've seen have started with the market issues or pricing issues, but whether the company bounces back or not depends on who's behind the business. And the third element is product diversification. We see some of our investees diversifying from coffee to cacao. Most of the times, they sometimes add a third product like sugar cane. But beyond product diversification, I want to highlight buyer diversification. To me, that's equally important because in a context where the liquidity is uncertain, a company that is able to swiftly reallocate product from one buyer to another or have buyers interested in more than one product, if one buyer defaults, substituting that one swiftly, to me, those have been some of the success factors we've seen at MC to be able to support the company throughout restructurings and then seeing them come out of that and thrive.
Thanks, Maria. And I think you both have spoken about how risk is tied to the management of the SMEs. We see that weak management teams struggle and the strong ones are the ones that overcome risk. And I'm wondering if you can expand, Maria, on how you've seen this in practice and what that looks like in reality on the ground.
Happy to be challenged by anybody in the room, but something that we have seen at MC is something that it does concern me as I wear the risk hat within my company, and is that resilient companies in some cases are becoming less resilient. And that's not because of market or prices, it's just because of internal management challenges. Management teams not only need to handle crisis, they also need to be prepared to manage growth. And that, to me, is when it gets tricky. One pattern I keep seeing today and for the past years is that we support an organization. We come in, we support an organization year after year. Even with the small ticket sizes, we keep growing together with them. And then it hits that milestone. Equity and debt finally start flowing in. But the management team has been stretched so thin and for so long that they struggle to absorb that the next phase of the business. Instead, then becomes some kind of pressure. So I keep asking myself, how can we better support agri-SMEs management teams before they hit that growth cliff? And I'm going to ask the room, and of course, it's happy to hear from the peers participating. Does anyone else find incredibly difficult to recruit strong CFOs for agri businesses? And to me, I understand the reasons, right? I mean, CFOs are expensive, the role can be undervalued. Usually the company is already scaling fast, and then suddenly the need comes. But usually what we find is treasury or accountants, like I call them heavily pressured accountants. So that's why I was intrigued by initiatives that are coming up, like, I don't know if the people heard about it, Do Good CFO, which is a US-based group that saw the gap and is trying to cover that through external CFO support for those agri-SMEs. So those are some of the initiatives that I've seen happening, yet it puts a question mark to the bigger need. So this proactive capacity building and investment in the management teams before capital comes in, not when it's already there.
Yeah, that makes sense. And I see there's already people in the chat confirming that CFO as a service is a really important support, and even others offer this to their portfolio companies. One of the keys, I think that in terms of better supporting agriculture SME management, again, it's a really important question. And I think it raises again the topic of reduced aid spending. Not all CSAF members were receiving aid from USAID or others directly to their operations, but many had businesses and borrowers who were either directly or indirectly receiving support services that have been funded by aid. So I think it's a really important context. I know a lot of people in the audience want to be hearing about that today. And I'm curious from a lender perspective, how each of you might have already seen that impact across your borrowers, and what that means for you as a business in terms of how you're trying to respond. So would love to start with Paul, and then also turn the question back to Maria again.
Thank you, Andrea. I believe that this current aid environment really gives us what I would call the naked truth, no? In terms of spotlighting the inefficiencies of the cooperative model and challenges the producer groups to become self-sustaining. With donor aid, they previously didn't need to fill really in those gaps because donors or development institutions were stepping in. So now the COPs need to tighten these inefficiencies and manage a more robust business model without reliance, or let's say at least less reliance on TA or grant funding. That would be, for me, the ideal scenario. But reality, we know, is different. Producer groups not only require finance, they also require some sort of subsidy because they truly are still in a disadvantaged position to face the multiple challenges that the market puts on their way. And you name it: climate change, EUDR, US tariffs, organic regulations, volatile prices, shipping issues, and the list goes on and on. And then we as financiers need to accompany them for quite a long time until they reach a satisfactory maturity level. So for shared interest, we have supported, as I mentioned before, the smallest COPs and agri-SMEs, and we have observed somehow that our funds with those very small tickets have acted as a sort of catalytic capital, attracting other investors or lenders now willing to support those farmer groups.
Thank you, Paul. Maria, I would love to hear you expand as well. And then after that, we can jump into the Q&A. I want to make sure people have time to ask questions. So those in the audience can start adding your questions to the chat, and we'll try to answer some of them. But first, go ahead, Maria.
Absolutely, thank you. So when I was thinking about this question, I confirmed myself, yes, it is shrinking, but it does not only mean that there are less de-risking mechanisms available or less technical assistance funding available. It also means to me that there's a smaller pool of capital for impact investors to deploy as we try to close our funds, as we try to design new ones. So the feeling I have is that for many SMEs, it feels like the world is closing in. They're being asked to do more, to continue growing, to become resilient, to mature as business while receiving less. So what at MC we've seen are two things. First, that those companies that are able to adapt to suddenly support dropping are those that have strong and trusted networks of stakeholders. Because through those stakeholders, they're able to replace the traditional aid with some other form of capital, sometimes flexible debt, sometimes equity, sometimes just the goodwill and credibility over the years that they build up, anything that helps them moving forward. I've also seen organizations adjusting their business model in its entirety, due because of the absence of that aid that they were counting on. But that kind of pivoting requires a lot of things, requires deep internal alignment that includes board, management, staff, us lenders, beneficiaries, and also requires flexibility. It requires sometimes bridge financing. It might mean for the lenders renegotiating loan terms or leaning on shareholders for an unplanned equity injection. So going back to my previous answer, that is where the lenders have a role to play. Sometimes we focus on the impact when we do new loans, but what we don't focus is the impact that we generate when we're able to give time to the companies to reshift themselves, especially in times like we're living today.
Yeah, I think that note about the maturity level of these businesses that are able to pivot is so important. In this year's report, we featured 2 case studies of SMEs that were able to diversify into a second value chain, one in Guatemala and another one in Cote d'Ivoire. And these are really exemplary examples. And, these exceptional cases are because those SMEs had strong management teams, they had long-term partners, they had equity cushions. And I think it's important to note that those pieces need to be in place in order for an organization to have that capacity to pivot and diversify and create a more sustainable business model. And so lenders really have a role to play to accompany these younger and less mature SMEs to get to that exemplary stage. Well, we're already 1 hour in, so I want to open up the Q&A. We booked another 15 minutes to make sure we have some time for the audience to ask questions. I saw a couple questions come in, and maybe I will start with one that came from Divine about considering the impact of US tariffs on West African commodity exports like cocoa, coffee, and cashew. How do we foresee these tariffs affecting producers and CSAF lenders in the region, and what kind of strategies can mitigate those impacts? This is maybe 4 or 5 questions in one, but we'll try to see what we can get back to you, Divine. I think Paul and Maria, you both oversee West Africa as part of the global portfolio that you're responsible for. Do either of you want to tackle this question and give your initial thoughts?
Maybe I can start, and then Maria can help me to complement it. So what we have heard so far from buyers is that they plan to initially transfer these tariffs into the final consumer. So now, if that is fully possible or not, that is, of course, yet to be seen, because eventually the market can react towards those higher prices and demand can shrink. So then the next potential step is that buyers are forced to return, let's say, or renegotiate some of those prices paid to producers to acknowledge some of those tariffs. So I don't think I'm going to be wrong if this is going to impact prices down for the farmers, because farmers tend to be the so-called weakest link. So they tend to have the less capacities of negotiation, or weakest entities. If you compare it, perhaps well-developed international buyers that purchase massive amounts of coffee and cocoa, no? So the way to tackle for me, it's making this business more efficient. Now, if your processing costs, your operational cost increase, the only way to face them is to become more efficient, to find other savings, other improvements that can mitigate and the new reality. Because trying to fight the reality is just silly. Then you just deal with the situation and improve it to manage that new challenge. Because tomorrow another challenge would appear. Now we call it US tariff. Tomorrow you could call it the way you want. So the constant will be these forever changing variations, and just as CSAF members and with the support of field building partners, we need to find ways to help producers to navigate these complexities.
I'm not going to add to that because I fully agree with Paul, but maybe just sharing some of the trends I see in my organizations at the risk of US tariffs coming in. During these 6 months, what they've been looking at is commercially opening markets, and that obviously doesn't come automatically. It takes a commercial effort to be able to start looking at other regions in the world where the things like the premium can be preserved, so they are able to still pay farmers what they're supposed to and be able to cover costs. But there are some regions that start coming up, like whoever doesn't want to sell to the US, sell to us. I've seen that in Australia, I've seen that in the Middle East, and that's where some of my companies are looking and engaging to be able to maintain that diversification. And look, if it's not worth to be selling to the US, try to substitute part of that coffee flow or cacao flow towards other regions as much as possible.
That's a really interesting trend, Maria. I'm curious if you've also seen that as a reaction to EUDR. I know that some cooperatives, even though they themselves are not, or like their farmers are not deforesting land, it's hard for them to make sure that they're compliant because of the demands in all of the data collection that it takes to comply with EUDR. So are you also seeing that transition to Australia and Middle East as a response to EUDR?
That was the reason why I didn't mention EU. Exactly.
Yeah.
And that's also tagging to my previous statement that I feel that the world is shrinking for these companies, and they need to find those other regions that maybe were not prominent, but they have strong demand to be able to further diversify and try to maintain certain level of price to be able to continue paying fair prices to the smallholder farmers.
Great, thank you. I see a comment from Miriam in the chat, more of in addition to the conversation, that Oika Credit, another CSAF lender, is also piloting granting technical assistance to hire an expert to help their organization revise their processes and control, segregation with off-takers, segregation of duties in order to improve efficiency. So it sounds like there's a lot of support that's being provided by different CSAF members and lessons that we can share internally and with the group. I see a couple other questions coming in, so I will read them live. Have you invested in finance companies specialized in agriculture trade finance, particularly those with existing relationships with off-takers? That seems like maybe more of like in the financial inclusion portfolio, if I'm interpreting the question correctly. So maybe I will answer that. There's several CSAF members. Everyone has a different strategy. What United CSAF members is all of them are investing directly in agriculture SME investment, which is the lens that we look at as a group. But many lenders are also lending to their financial inclusion portfolio, which might include MFIs, as well as sort of more boutique financial services. I know like El Grano is an example of a service that receives investment from one of the CSAF members that is helping to facilitate the trade flows of coffee, and there's other examples as well. But the depth of those investments is pretty broad, so I don't know if we'll have time to answer that on today's call. And there's another question here from Bryce. what would be an appropriate way for CSAF lenders to leverage donor subsidized capacity building programs that already exist, acknowledging that each program has their eligibility criteria, geographies, et cetera? How can we leverage these programs to cater to the need to strengthen portfolio companies' management teams, as mentioned by the panelists?
I do have one suggestion, Andrea, here,
Sure.
that I've been thinking long about it. And to me, that's knowledge. As CSAF members, we have a lot of knowledge. I bet that every single of us, especially we're in the risk side of the business, we have conducted default analysis. At the end of the day, what happens? What are the elements that makes a company thrive even throughout crisis or not? And that was our conclusion at MC, right? So obviously looking forward to hear from others at a certain point in time. But if we're able to get that data consistently telling what those companies might need, that's what you need to leverage with donors, right? Because of course money is shrinking, but there's still people raising the hand trying to deploy grant funding, donor funding into the sectors. So it's just about sometimes about using a light and just showing them from our experience, those are the things that could be prioritized, and that the catalytic impact it would have would be tremendous. Maybe it's not sexy saying these guys will survive when a crisis comes, but that's a fact, right? And that's an important thing to continue sharing.
Thank you, Maria. Hopefully that answered your question, Bryce. And we have another great comment from Alex from Alterfine, just confirming that the CFO issue is a real challenge and that lenders, we must come together to pay more and look harder to attract good profiles. And Alex also reiterated the support for joint monitoring, which is a really crucial thing that CSAF members work on together. We have 5 minutes left, so I'm gonna take advantage of those 5 minutes to also ask you both about the outlook for the rest of 2025 and going into 2026. And I think that, we're halfway through the year. There's a lot of key challenges that you might still foresee for the remaining of the year. And one question I have in particular is just how the sector needs to continue to attract capital when there are less support systems in place. Maria, earlier you mentioned just the shrinking pool of capital available, and then that's complemented by increased risk. So would love to hear how both of you are thinking about that right now. Maybe Paul, you can start, and then Maria, you can close us out for the webinar.
Yes, so to address the first part of your question about what's light ahead, I think I started with the topic of prices, so I will address it from that perspective. There's still quite high price volatility. It's very, very tangible, especially for producer groups trading in commodities. We as lenders need to carefully monitor these movements. In coffee, we've already seen lower prices since March 2021 onwards, and the equation is not complex. If you purchase coffee from your farmer at high prices, but later fix it at lower prices to export it, then you make a loss. So, and we do not know if the reducing tendency will continue or not. Whoever tells you what's going to happen with the prices is lying. So therefore, we need to monitor and accompany producer groups in this second half of the year, whatever it goes up or down. So I do think that we still need to see in the second half of the year the implementation of UDR. I believe it's well advanced for several of our CSAF customers, but not necessarily for every producer group. We know it's not a one-time effort. It requires implementing adequate processes, introducing new business practices, traceability systems that facilitate reliable data collection longer term, among other challenges. And as a final reflection, I would like to think that everyone that is attending this webinar believes in the greater good in some way or another. So even if it means sacrificing a little bit of risk or comfort, we take risks, we face them, we do not run out of them, we solve them. We as CSAF members help producer groups to solve them, so to become more resilient. behind that lovely coffee cup, the chocolate bar, or the pack of cashew nuts that we all enjoy, there is a smallholder farmer facing myriads of difficulties, and that it's worth the effort.
Thank you, Paul. That's a really compelling message to leave us with. Maria, do you want to also share your perspective on how you're looking at the rest of the year and what's facing us ahead?
Yes, absolutely. So to me, maybe more about or less about how we're looking at the year as we are navigating as the rest of people here throughout the different challenges that come our way. To me, the important point is how do we continue leveraging? So despite some entities are stepping back, there's some other entities that step up. And to me, the answer relies on reminding everyone what agriculture represents, and that not with anecdotes. Anecdotes are very nice for color, but with facts. Facts by large organizations that have been looking at agriculture for decades, like World Bank, the COP reports, you name it. We need to remind ourselves agriculture is one of the most powerful engines for poverty reduction and economic growth. And it's not me saying it, it's not Paul, Andrea, it's a fact. The impact that it has is 2 to 3 times greater than other sectors, and especially for the poorest. So it is at the center of creation, of job creation, of nutrition, of climate and action. They can cut nearly 1/3 of global emissions. And yet, going back to one of my comments, smallholders producing 80% of the food in Africa, less than 3% of climate finance goes to those food systems. It's 80% against 3%. 2 billion people remain food insecure as a result. So let me share some of the things that we've been doing at MCE. We have been revamping our strategy at the beginning of this year. And somebody asked whether this was the right moment for us to do that. Look, uncertainty, maybe we should wait, we don't have enough visibility. Could this be a second COVID where we need all to pause and wait? But one of our stakeholders, when asked why would she decide to continue supporting MCE, put it best. And she said, if not me, who? If not now, when? And that's the message that I want to compel to the people in this webinar. Yes, capital is tighter. Yes, the world feels extremely uncertain and small suddenly. We'll want to look at the moon for placing some investment, right? But agriculture is foundational. It needs actors stepping in, willing to take a stand. And my question is, who are the ones raising that hand? Because I cannot believe that there's nobody raising their hand saying, look, I'm still willing to move forward in this sector. We just need to put our heads together and be able to work as a community and not in silos, because in silos we will achieve nothing.
Thank you, Maria. That really speaks to the spirit of CSAF and is a really compelling message to leave the audience. I think the audience is full of people who are willing to raise their hands, and if we can raise those hands together, then it's the best way to tackle these challenges moving forward. So thank you, Maria, for that message. Thank you, Paul, also for joining the panel and for all of the insights that you've shared. And of course, thanks to Ada for delivering the data each year and the insights that come with it. I'm really grateful for everyone's time, and thank you for the audience members who are staying on and asking your questions and staying engaged. We will share a recording of this webinar, and so you can share that with your colleagues, and we'll look forward to seeing you next year with a new set of insights. Thank you.
Thank you.
Thank you all.